So this is a mini LBO exercise just to give you an idea, a slight taste of what leverage buyout models look like and how the financing structure, debt in specific, affects an investor's IRR from the private equity's point of view. So we have already provided you with the EBITDA and EV/EBITDA multiple assumptions. You can see that EBITDA is growing at 15% per year, so it's a very healthy growth in terms of EBITDA. Even the multiple is also growing 0.3 times each year, so it starts from 10x to 11.5x after 5 years. So basically we can calculate enterprise value just by multiplying EBITDA to EV to EBITDA multiples. So upon entry, your enterprise value was around 1 billion. Upon exit, 2.3 billion. In this case, for now, we don't have any debt, so equity value is going to be simply enterprise value minus net debt. So, enterprise value equals equity value, and basically, if you invest 1 billion, after 5 years, you're going to get a multiple of 2.3 money over money multiple. So it's very simple, fairly simple. And now let's assume a little bit of debt. This is assuming just we invested 100% using just cash. Now the private equity wants to raise debt and make 80% of their investments by debt. So the private equity is going to invest 80% of the entry equity value, which is 800 million in this case, and basically the rest we can comfortably assume that it's all cash. So it should be 200 million, correct? Right? And a simple debt schedule that we have learned from Financial Modeling 101. So let's assume that it's a 5-year debt, so 5 years of amortization, so 20% each year. The ending balance of the debt should be 800 million. And we always know that the beginning balance equals the ending balance. So everything's the same that we've done in Financial Modeling 101. And ending debt balances would be beginning balance plus whatever has been issued or repaid. If it was repaid, it would be a negative sign, so automatically we reach ending balances. And since we have to repay for over the course of 5 years, we're simply going to divide. We're actually going to anchor this and divide it by 5 years. Also, we're going to anchor this. So there's going to be actually a negative sign on the front. So a $160 repayment, $1 million repayment each year, and our debt balance that after 5 years would be zero. Everything would be repaid. Also for the interest expense as well, similar to what we did, we want to make an average of the beginning balance and the ending balance. We're going to take the average. Let's assume an interest rate of 4%. And now it's very simple. So average debt times 4% would lead to interest expenses. And you can see that as the company repays debt, interest expenses decline dramatically over time, which is fairly natural. And lastly, let's also connect the net debt balances to our prior assumptions. So we have to you know, we're assuming that the company has no cash, so net debt equals just ending balances of debt. All right. So leverage does change. Oh, and by the way, this, well, we can put in 800 if you want, but we're gonna leave it like this for the moment. And you can see that equity value increases dramatically over time as the company repays debt. So let's go over to the calculation of the IRR. This same frame is going to be used in our full-scale LBO model as well, so we might as well understand this when we can right now. So what we're going to do is we're going to add up the investor cash flow. So in this case, investor cash flow is going to be the initial investment, the interest payments, and the principal repayments, and lastly there's going to be exit proceeds upon exit. So exit proceeds can be proceeds from selling to another company, or it could be proceeds from going to an IPO and selling of stakes publicly, or it could be a dividend recap. We're gonna cover those exit strategies in a moment, but anyways, exit proceeds is the cash inflow from the investor's perspective. So the initial investment by the company should be, we're going to put a negative sign on the front. It should be 200. That's the only amount that the private equity has invested. Next, interest payment. We have the interest expense numbers here. So a minus sign, a negative sign on the front. Interest payments are also going to be made, as well as the principal payments. We don't need a negative sign because it's already negative. And lastly, the exit proceeds. How much is the company going to, how much are the investors going to receive upon exit? It should be the equity value, because debt has been already paid, and the private equity, we're assuming 100% stake acquisition, so the company has recovered 2.3 billion. So investor cash flow should be the sum of these cash flows. And calculation of IRR is relatively simple because we're assuming that investment has been made at year end, at the year end periods and the end periods here as well. So we can simply just use an IRR function. That's all we have to do. So it's a 29.2% IRR. And the money on money multiple, initially the company invested 200, so we're going to add all of this and divide it by the initial investment. But we have to put a negative sign on the front. Whoops. And now we can see that, according to these assumptions, so number one, EBITDA grows at 15% per year. EBITDA multiples expand at a 0.3x pace annually. And lastly, 80% of debt was used. So these three assumptions combined result in an IRR of 29.2 and a MOM of 7.2. So let's see if this works properly. For example, let's assume that there was something negative to the operations of the business, and maybe EBITDA falls to 10%. So when we change EBITDA to 10% growth rates, obviously IRR should decline, and you can see that IRR declines. Slightly sensitive, I would say. Let's change EV/EBITDA multiples to maybe no expansion at all, so put 0. And of course, prior to our 29% IRR, it drops slightly, and not slightly, but a considerable amount. Let's change debt used to 0%. Let's assume, we came to see this. This is what we really wanted to show you, that leverage actually benefits the returns. So let's assume that 0% debt was used and it was 100% cash investment. In this case, IRR drops to 18%. It's almost a 10%. It's more than a 10% point drop. It's quite significant, and compared to when 80% debt was used, it's quite different. And it's not only the differences in the IRR, but also it's the fact that you only need 200 million to make this investment happen. Before, if you don't use any debt, you would need a full $1 billion to make this investment. But instead, now you only need 200 million, and if you have more money, you could use the money elsewhere. So that is another benefit of this leverage buyout model, because you only need a very limited amount of initial equity. Lastly, let's also see the value creation as well. So where does this return? So where does the returns from the private equity's point of view come from? So the return is actually this amount actually this amount, right? This amount plus this amount. The return from the private equity's point of view is slightly over 2.1 billion. How much does EBITDA expansion contribute to this number? So how we're going to calculate this is that we're going to anchor the entry EV/EBITDA multiple, but multiply it to the differences in EBITDA. So what we're going to do, we're going to subtract the beginning year's EBITDA from the ending year's EBITDA. So this is going to be the EBITDA difference. So how much EBITDA has grown times the initial EV/EBITDA multiple. So it shows how much enterprise value was affected by EBITDA expansion, and you can see that almost half of it came from EBITDA expansion. We're going to do something similar for multiple expansions as well. So this time we're going to subtract beginning multiple from the ending multiple, and we're going to multiply to the last year's EBITDA. And the remainder should be coming from financial engineering, which in this case is exactly 800. So the amount that we initially raised as debt. In terms of percentage, F4, we're going to anchor the denominator. And we can now clearly see that almost 50% of the returns, total returns, came from EBITDA expansion. and around 15% and 35% came from multiple expansions and financial engineering. Let's see if this works as well. Let's assume 0% debt used. So we are expecting this to change to 0. So it should be 0. So no value creation from financial engineering. If we change this to 99% debt, it should be almost close to 1 billion. Let's also assume a little bit more aggressive EV/EBITDA expansions. In this case, now the scenario has changed. Well, this remains, same at 800, but multiple expansion now up to 25% contribution to value creation. So what we can learn from this simple mini LBO model is that the IRR profits, it comes three ways. It comes from EBITDA expansion, EV/EBITDA multiple expansions, and leverage. What the private equity wants to do is, well, initially it's aiming for all three, but at least two. Especially EBITDA expansion is, critical for the company to grow equity value. This financial engineering could be done by the private equity firms themselves. So this is chosen somewhat by the private equity. However, repayment of the debt and the ability to the ability to pay interest expenses highly depend on how much EBITDA the company can generate. So eventually, this EBITDA assumptions are going to be very, very important in the LBO model. That's why we also need a full-scale street statement model, and we're going to put a lot of effort into that. And lastly, the EV/EBITDA multiples. It's very hard to predict. At least what we can do is try to enter the deal with the lowest multiple possible, because you don't know what the industry's situations are going to be at the time upon exit. But anyways, that's it for now, and let's discuss much more after building our full-scale LBO model, which is going to be much more complicated than this one. But if you have understood all of this, and if you have understood Financial Modeling 101 and 201, from my experience teaching people in offline courses, it shouldn't be that big a problem.